Hello, everyone. So, welcome to another chapter or welcome to another topic. So, first of all, let me share my screen. Well, I hope that you all can see my screen very clearly. I think it's properly shared, right? And also, I believe that you all can hear me well, right? Okay, so I believe that you can see me, you can see my screen, and also you can hear my voice. All right. So now, what is the topic? So as you all can see, today, our topic is, or we are going to discuss the cost of capital. I don't know whether you have heard this before, the cost of capital, but this is what we are going to discuss, right? Cost of capital. And this is very much important if you are into the finance field. If you are a finance manager or if you are doing anything which relates to the finance, this cost of capital is essential. And even before we are going to talk about the financing decisions, right, this cost of capital is very much important. So that is why before we are going to discuss the financing decision, that I picked this topic, which is the cost of capital, because this is very much important. Without having the knowledge of cost of capital, you cannot do the financing decisions, right? So that is why this cost of capital is very much important, right? So moving ahead, this is the chapter outline, or these are the points that I'm going to discuss with you throughout this chapter, right? So the first one is the cost of equity capital, second one is estimation of beta, third one is determinants of beta, fourth one is extensions of the basic model. So these are the points that I'm going to discuss with you. All right. Okay, so let's start our topic today, which is the cost of capital. Right. So as you all can see, there is a nice picture here, right? So what is the heading, or what is the subtopic? The firm and the financial markets. So you all can see this picture. So I'm going to elaborate this picture to you, right? So you all can see that this blue color box, that is the firm, or that is your company, right? So this brown color box, that is the financial markets. Let me explain you what is this financial markets. And this black color box, that is the government, right? So you have three main boxes: firm, which is your company, and the financial markets, and the government. So when it comes to the firm, you know what is the firm, right? Firm is the company, right? So firm is the company, means this is what you're doing. This is your business. This is your company, right? So that is your company. So moving to the financial markets. What is the financial market? Financial markets includes all the financial institutions like banks, investment bankings, other financial institutions. So likewise, all the financial institutions are there in the financial market. And also other financial regulations are there in the financial markets, right? Colombo Stock Exchange maybe, then Securities and Exchange Commission maybe, right? And all the regulations and rules are there in the financial markets. And also when it comes to the financial market, this includes all the financial instruments. What do you call by instruments? There could be short-term debts, there could be long-term debts, there could be equity, right? So all the financial instruments are also there. So likewise in the financial markets, actually when it comes to the firm also, firm is also part of the financial markets. But in order to describe this story in here, I have divided this firm, financial markets, and government into three. But anyway, government is also part of the financial markets, Lama. But anyway, for you to teach this, right, I just categorize this into three boxes. Firm is a one box, financial market is a one box, and government is a one box. So for firm, that is your company, or that is your business. And when it comes to the financial markets, financial markets includes all the rules and regulations, all the institutions are there, and all the instruments are there, financial instruments are there, right? So likewise, and when it's come to the government, what is government? Government is your Raja, right? That is simply your government, right? So now let's come to your firm or your company, right? So in order to carry out your business operations, right, or your day-to-day business activities, you need cash, right? You need cash. But right now, just think that you don't have any kind of savings or you don't have any cash within your company or within your firm. So what you need to do, you need to go to the financial markets in order to incur some cash, right? So what are the ways that you can get some cash from the financial market? Either you can get cash through debts, or either you can get cash through equity shares, right? So these are the two options that you can get, right? So what are the two options? Now let's say this is your firm, you don't have money within your company, or you don't have cash. So what you're going to do is you go to the financial market and you are asking money. So there are two ways that you can ask money. One is you can issue securities, right? And the other one is that you can ask for debts, right? So there are short-term debts or there are long-term debts. Altogether, we can call this as debt or external debt, or else we can issue securities, right? So anyway, right, what is going to happen is when you don't have cash, you go to the financial markets to ask for money. So there are two ways that you can receive money: through through issue of debts and equity shares. So the first thing is that you are going to collect cash, or you are going to receive cash through debts or through equity shares, right? So that is the first thing. Then now you have enough cash, you have enough money within your company. So now what you're going to do, your capital budgeting decisions or your investment decisions, now you're looking for investing your money or investing your cash in current assets or fixed assets. See, investments in assets. See, you are, firm issues securities or firm receives debt. So using that cash, what you're going to do, you're going to invest those cash, or you're going to invest those money in current assets or fixed assets, in current assets or non-current assets, right? So that is the second thing. First, you didn't have money, so you go to the financial market and you ask for money, and then you receive money. By receiving those money, what you're going to do is you are going to invest those money in short term assets, or current assets or non-current assets, right? Then what's going to happen? So why you are investing in those such current assets or non-current assets? Because you know that you can get cash flows, because it generates cash flows. These current assets or these fixed assets, it generates cash flows. So by having that intention, or by expecting that you can generate future cash flows, you are going to invest in current assets and non-current assets, right? So then the third thing, or the C, that is you can get cash flow from the firm. Why? Because you have invested in current assets or non-current assets. So that means you can get cash from firms, right? Okay. Right. So what I have discussed with you is that we have firm, financial markets, and governments, right? So when the firm doesn't have money, or when the firm out of money or cash, they go to the financial markets and they're requesting for money. So how they can get money, or how they can receive money? Through debts or through equity, right? So now let's say they have issued security, or they have gone for debts. So now in turn they are getting money, right? So using that money, either through debt or through equity, now they have money. So through that money, using that money, they are going to invest in current assets and fixed assets, current assets or non-current assets. And by using this current assets or non-current assets, what firms going to do is they are going to generate cash flows, right? Over the years, when they are working with these fixed assets and current assets, they are going to earn money, right? Now let's say they invest, let's say 2 million in a building. So by giving that building for a rent, they can get a rent income. So that is also one kind of a cash inflow. So likewise, they can generate cash flow, right? So now they have money because it generates cash flow. So by using this cash flow, what the firm needs to do is, first they need to pay taxes to the government, which is one of the regulations, because that is kind of a corporate tax that the every company needs to make, right? There is a corporate tax rate. You go and find it out, right? So there is a corporate tax the companies need to pay. So as soon as that you generate money or cash, you need to allocate some money or allocate some funds for to pay the taxes. That is why after you generate cash inflow, then the next thing is you need to pay the taxes. That is why the letter D is there. A is you can ask money from the financial markets, then from that you can get debts plus the securities. Then you can invest in the investments or the assets, that is B. Then you, from that you generate money, that is why the letter C is there. And then as soon as you receive the money, you have to pay the taxes to the government, that is one of the income, um, one of the incomes of the government. So you have to pay the taxes to the government. Then what else you need to do with the remaining money? You need to pay dividends to your shareholders. If you have if you have received money or created money using equity shares, that means you have shareholders. For the shareholders, that means you need to pay dividends as a return to the shareholders, right? So you need to pay dividends. And let's say you have gone for debts, so there are some debt holders, you need to repay the debt to the debt holders, right? So these are the two things. Let's say you have received money from equity shares, then there are shareholders, so you need to pay dividends to them. Even let's say you went for debt, so that means you need to repay those debt to your debt holders, right? So that is the next thing that you need to do. And after that, if you have any remaining money, then you can retain your cash flow within your firm, right? That is the next thing, right? You can retain some cash in your firm for your own growth or firm growth or the firm development, right? So that this is the firm and the financial market. This is kind of a circle, or this is the meaning of this picture, right? So if I quickly summarize this, there are three boxes which represent firm, financial markets, and the government. So financial markets includes all the instruments, institutions, rules and regulations and everything in the finance, right? Intermediaries, banks and all. So if the firm out of money, out of cash, they needs to always go to the financial markets to ask for money. So they have two options: either they can issue securities, right, or else they can ask for a debt, right? Let's say we have both. We have raised the money using both the ways, let's say debts and equity. So now we have money, right? So using that money, we are going to invest in some assets. It could be the current assets and non-current assets. And after that, over the period, over the years, the current assets or non-current assets, they are going to generate cash flows. So using that cash flows, we need to pay the taxes to the government, because we need to comply with that. It is a mandatory requirement, right? The tax rate is imposed by the government, so we have to adhere to that particular tax rate. And after that, if you have any remaining, first you need to pay the dividends, and the first you need to pay the debt repayments to the debt holders, and then you can decide whether we are paying a dividends to our shareholders or not. And then after that, if you have any remaining money, then you can retain it within your company, right? Because if you want to see your company growth itself, or for a company development, again, if you want to invest in some kind of capital investment, you can retain any remaining amount, right? So this is it, right? So this is the firm and the financial market. This is, I just want to I just want to tell you the story, because if you don't have the idea of this story, you cannot go ahead, right? I hope this picture is very much clear to you, right? And here, the ultimately the firm must be a cash generating activity. So ultimately the firm is a cash generating activity, because they ask money from someone else and they invest. Then ultimately they are just generating cash flow from their current assets and non-current assets. The cash flows from the firm must exceed the cash flows from the financial market. The cash flows from the firm, that means the cash flow, this firm, I told you that the money, which the money should invest in current assets or fixed assets, no? So the cash generated from this fixed assets or non-current fixed assets or current asset should exceed the cash flow from the financial market. That means like this. Now let's say when the firm doesn't have money, they go to the financial markets, no? Now let's say from the financial markets they receive rupees 1,000. What this sentence tells about is that if you receive 1,000 from the financial markets, in turn you have to generate at least 1,000, at least 1 rupee, 1 rupee above the 1,000. That means lamai, if you have received 1,000, එක රුපියලක් හරි වැඩිපුර මේ current assets or non-current assets වලින් you have to exceed, right? Now let's say the financial markets, you have received 1,000, so you have to at least you have to generate එක රුපියලක් හරි වැඩිපුර උපයන්න ඕන, නැත්නම් ඇති වැඩක් නැහැ. Because otherwise you cannot repay all the money that you have taken from the financial markets. So let's say from the current assets or fixed assets, you have generate, let's say 2,000. So that means when you can pay the 1,000 to the financial markets, because you have borrowed money from someone else. So first thing is you need to repay that. And if anything remaining, you need, first thing is that from this 2000, you need to repay this 1000, and then even you have to pay the taxes. And even if there is anything else remaining, you can retain within the company itself. So this is kind of a circle, or this is kind of a cycle that every firm needs to go through, right? If you have your own money, then no matter, you can use your own money. But if your company doesn't have money, definitely you need to go to the financial markets to ask for money, and then you can get debts or equity shares, and using that money you can invest in current assets or fixed assets. Then by using them you can generate some cash flows. Then those cash flows you have to use to pay for taxes, and then you have to use them to pay dividends and the debt repayments. And also if anything remaining, you need to allocate them for reinvestments to the company itself, right? So this is the story of this picture. Okay, moving ahead, the cost of equity capital. Now we are coming to the topic of our lesson. I mean the topic now only we are coming, because we can't go to this cost of equity or cost of capital without having the knowledge of the previous slide. So now you know how the cash is inflowing to the company, right? What does the firm do, right? Likewise, now you have a kind of an idea. Now let's look into this cost of equity. Okay, right. So forget about this picture for a while. Forget about this picture for a while, right? Now, in the previous slide, I told you when a firm doesn't have cash, they have two options: either to, go for issue in equity or issue in shares, or they can ask for a debt, right? So what do you mean by equity in shares? That means if this is your company, you are going to divide your company ownership into small uh component. I mean, you are going to divide your entire company into small parts, right? Then you invite the external parties or the people who would like to invest in our company, right? You are just going to, what you're going to do is, your entire company you are going to, segregate into maybe equal parts, right? Then you are inviting, you are, you just give, you just invite other people to come and invest in our company by taking or by purchasing such a share, right? Or a part of your company. So that is what you mean by equity share. So what you're going to do is, let's say the company value is, let's say 10 million. So what you're going to do is, you are going to, segregate your 10 million, right, into small part, or you are going to divide your company 10 million into small part, and then you are inviting all the other people to come and invest in such a, let's say one part of the share is, let's say rupees 10. So you are going to divide the entire 10 million into each 10 share, rupee 10 share. ඒ කියන්නේ මිලියන 10 10 කොටස් වලට කඩනවා. Then the people who would like to invest in your company go and buy such a small share. If they want, they can buy only a one share, rupees one share, 10 rupee one share. Or else they can buy 10 into 100 shares. Even they can buy 1000 shares. That is based on the money that the people have, right? That depends. So even I also can go and buy such a share. So that is equity. So when you don't have money, you can divide your company into small shares. Then you can invite other people to come and invest in my company. So by doing so, you are just getting cash. That means you are not going to divide your company into small part. What you're going to do is, you go to a bank or you go to someone else, and you are just asking for a kind of a loan, right? You're just asking for a kind of a loan. Then that particular person is giving you money with the interest, right? That is debt. So these are the two ways that you have, right? So now, Lamai, do you think that there are people who come and, give you money if they don't get any return? කවුරු හරි කෙනෙක් ඇවිල්ලා ළමයි මොන හරි කම්පැනි එකක ඉන්වෙස්ට් කරනවද? ඒගොල්ලන්ට රිටර්න් එකක් ගන්න බෑන. ඔයාට ණයක් දෙයිද? ඔයාගේ අම්මා තාත්තා යාළුවෝ හිත හොඳින් දෙනවා ඇරෙන්න. පිට මිනිස්සේ කවදාත් ඔයාට ගෙනලා ණයක් දෙයිද? ඔයාට වාසියක් නැත්තම්. කවුරු හරි කෙනෙක් ඇවිල්ලා ඔයාගේ කම්පැනි එකේ ඉන්වෙස්ට් කරයිද? එයාට වාසියක් ගන්න බැරි නෑ. He's always looking for return. No, I'm just telling you again, don't, just listen to what I'm saying only, okay? Okay, right? I'll explain and I'll come to this picture later. So when a company doesn't have money, they have two options: either to, raise equity, or to issue equity, or to go for a debt, right? So now, let's say I told you that if you issue equity, or if you're asking for a debt, outside the people come and invest in your company, right? So now let's say that there is a one particular person, right? He or she invested in your company by purchasing 1,000 shares or 100 shares. So why that particular person is go and invest in your company? Because he's expecting some kind of a return. So we call that this person, we call that return as expected return. We call it that as a expected return or a return. He or she is expecting some kind of a return. And also when it comes to the from the if somebody who, let's say this person is again gave some kind of a loan, again this person is expecting some kind of return, right? So we call it as return. By giving such loan, he is expecting some kind of a return, right? Because otherwise he won't give this money to that particular company, right? Either he is investing in equity, or either he is giving some kind of a loan to this company. He is expecting some kind of a return, right? That is from that particular investor's perspective. Now when it comes to company, right, let's say this is our company. So now let's say we have issue equity here, right? So when this person is expecting a return, right, for this equity, right, he's expecting a return. But from the firm's perspective, it's kind of a cost to me. I need to pay that return. He's expecting kind of a return, right? By giving or by investing in this equity stocks, let's say he's expecting a 10% return. So this 10% is a cost for me, right? When there is a cost for equity, we call it as cost of equity, right? That is how this cost of equity comes to this finance. Let's say this particular person has given me debt, right? So he's expecting some kind of a return, but anyway I need to repay it, so it's kind of a cost to me, right? He's expecting a return and I need to pay that. So when there is a cost for this debt, we call it as cost of debt. Cost of debt. Did you get my point? So altogether, the cost of equity and cost of debt, we call it as cost of capital. That is how this cost of capital comes to this, subject finance. I hope it's clear. So I told you that a firm has two things. Either you can issue equity and either you can go for debt. But when you go for equity, it's kind of a cost to you. You need to repay it to your shareholders. So we call it as a cost of equity. But from the investor's perspective, that is kind of a return to them, right? It is not a cost to them. But from the company itself, it's kind of a cost to them. So that is what we call it as cost of equity. But the firm is gone for debt, we call it as cost of debt, right? I hope it's clear. So all together, when we add both these together, cost of equity and cost of debt, we call it as what? Cost of capital. Cost of capital. I hope that is clear to you, right? I hope that is clear to you. So I think that would be enough for your level. Don't think about this picture, right? Just forget about this picture, right? What you need to get it to your mind is that if when there is a firm, if the firm wants money, they have two options: either to go for debt or for asking some kind of a loan from a bank or someone else, and either they can issue equity, right? So when they are dealing with equity, that is kind of a cost that they need to repay to their shareholders because they are getting money from someone else outside. So anyway, at the end of the day, they need to repay it. So when, if the firm is involving with those equity, we call it as cost of equity. But from the investor's perspective, that is kind of a return to them. And when you go for a, let's say the firm is gone for a debt, so from the firm's perspective, that is also a kind of a cost to them, so we call it as cost of debt. But from the investor's perspective, of for the bank's perspective, who given the loan to your firm, that is kind of a return to them, right? So the cost of equity and cost of debt all together, we call it as cost of capital, right? So cost of equity is there, cost of debt is there, so all together we call it as cost of capital. I hope it's clear to you. Right. Okay. So that is all about it. Just just forget about this. Okay. Right. Moving ahead. Right. Right. So now we are going to estimate the cost of equity. Now, right, knowing the cost of equity is not enough, right? You have to calculate the cost of equity. So that is a formula given here. So we'll see how to calculate this cost of equity, right? To estimate the firm's cost of equity capital, right? So that is cost of equity. We need to know three things, right? So when it comes to the cost of equity, or when you are going to calculate the cost of equity, you need to know three things. We'll see what are those three things using the equation, right? So this is the equation that you are going to use, right? So you all can see that there is an equation given here, right? So this is what we call it as cost of equity equation. We call this as cost of equity equation, or we call this as capital asset capital. I'll write it properly. So this is the cost of equity equation. So this is the equation that we can use in order to find the cost of equity, or as we can call it as capital. The same equation we can call it as capital asset. Just, just for your, knowledge, capital asset pricing model. So we call this as capital asset pricing model, or CAPA model, or we can call it as CAPM model. We can call this equation as capital asset pricing model or CAPM model. We can call it as like that, capital asset pricing model or CAPM model, right? So this is the equation that we are going to use if you want to find out the cost of equity, right? So in your examination also, if I ask you to calculate the capital asset pricing model or the cost of equity, what you need to do is you need to, write this capital asset pricing model equation or the CAPM equation, right? Okay, so here, right, so this is the cost of equity, right? So this is your answer, cost of equity capital, right? Or else, Lamai, I told you that even from the firm's perspective, that is cost of equity, but from the investor's perspective, that is the expected return. So even in the examination, if I ask you to calculate the expected return, this is the same. Even it's the expected return or the cost of equity, that doesn't matter, you have to use the same equation, right? Did you get my point? So either it could be cost of equity, or else either it could be what, it could be expected return. So get that into your mind, right? Expected return. So it could be cost of equity, or it could be expected return. It doesn't matter, because from the investor's perspective only, that is expected return. But from the firm's perspective, that is cost of equity. So, but anyway, in the examination, if I ask you to calculate the cost of equity, you have to use this equation, capital asset pricing model equation or the CAPM equation. Or else if I ask you to calculate the investor's expected return, the same thing, you have to use the same equation, right? Okay. So having said that, right, so this is the cost of equity or the expected return, and we call this as risk-free rate, this one, right? That is why I told you that you need to know three things, right? So the first thing that you need to know is, that is the risk-free rate, risk-free rate, which we call it as, or which we denote this risk-free rate as RF, like this. You need to write the R and then F, risk-free rate. We call it as risk-free rate. This is the first thing that you need to know if you are going to find the cost of equity. So what is this risk-free rate, Laman? This risk-free rate is, now let's say you are an investor. Harida, let's say you are an investor, right? So now you are looking, what are the ways that I can invest, right? You know that in the government, they also issue some kind of securities. Have you heard this treasury bills, treasury bonds? Have you heard this government securities, treasury bills or treasury bonds? I hope that you have heard this government treasury bills and treasury bonds, right? Even I'm pretty sure that you know that treasury bonds scam also. So that means you have already know this treasury bills and treasury bonds. So either I can go and invest in those treasury bills and treasury bonds. Even I can go and invest in such a company equity shares. It could be John Case shares, it could be Sampath Bank shares, it could be commercial bank shares. So in these two ways I can invest. But the thing is, Lamai, when you go and invest in government treasury bills or treasury bonds, we call them as default free securities. Default free securities. Default free securities, or we call it as risk free securities. Default free securities, or we can call it as risk-free security. That means, Lamai, when you go and invest in such a treasury bill or a treasury bond, the government makes sure that we are not going to default this. Definitely, we are going to pay this back. Let's say you go and invest in a treasury bill. Let's say the expected return. Again, from the government perspective, that is the cost of equity. Or else, let's say from your point of view, the expected return is, let's say, the 4%. So that means you are definitely after, let's say you have invested in the treasury bill or a treasury bill for only for a 3 months period of time. So the government is making sure that you are getting this 4% at the end of this 3 months, right? So that is the risk-free security rate, or that is the risk-free securities rate. That is what we call it as risk-free rate. So simply you have to, put this 4% here. So this is the government security rate. That means if you go and invest in a treasury bill or a treasury bond, if the government, government promising you that, or the government is assuring you that we are going to pay you 4%, if that is the government cost of equity, right? Or even that is the government cost, or even that is your expected return, we call it as risk-free rate. That 4% is the risk-free rate, or that is the government treasury bill or treasury bond rate, because the government is making sure that we are not going to default you. Even we don't have money in the government, even in the present government, let's say you go and bought a treasury bill, right, and the rate is 4%, right? Then the government is making sure even we don't have money right now, we are going to even print cash. We are going to print cash, and even we are going to print it, give it to you. That kind of assure that there is in treasury bills or treasury bond, but the rate is very much low, very much low. When you compare to a commercial bank or a Sampath bank, the rate is very much low. Let's say 4%. The treasury bill rate is 4%. So that is risk-free rate, but that is very much low, right? But they are just assuring you, but anyway, you don't have to worry. Anyhow, we are going to, even though the government collapse, or even though the government is not in a position to pay you, anyhow, bella gahala giyat, salary print karla hari, we are going to pay you, and you are going to receive your 4%. So that is the risk-free rate, right? But let's say you are an investor, you are not going to invest in a government security, but you are going to invest in a commercial bank security. Let's say you are going to go and buy a commercial bank equity. Commercial bank is going to, divide the entire bank into small shares. So you and go and buy such a share. So that means you are becoming a shareholder of that commercial bank. But commercial bank doesn't give you such a assure. අපිට සල්ලි නැති වුණත් අපි ගෙවනවා සල්ලි print කරලා හරි කියලා එහෙම එකක් commercial bank කෝ දෙන්නේ නැහැ. So there is kind of a high risk there when you compare with the treasury bill or treasury bond, because in a government they assure you that we are going to pay you the 4% at any cost. But when you go, you are just not going to invest in such a treasury bill or treasury bond, but you are just go and invest in commercial bank shares. So therefore, there is some kind of a risk, because the commercial bank, they are not promising you that anyway we are going to pay you in a default situation also. අපිට සල්ලි නැති වුණත් අපි ගෙවනවා කියලා එකක් පොරොන්දු වෙන්නේ නැහැ. එතකොට ඒ වගේ වෙලාවක, right, as an investor, you are expecting more than this 4%, because with the promise, if you can get a 4%, right? But if there is a risk, but even though there is a risk, you go and invest in a commercial bank shares, definitely you are going to expect more than 4%. This could be anything. ඒ කියන්නේ මේ 104 ඇතුළුව තව දෙයක් ඔයා බලාපොරොත්තු වෙනවා ඒ කම්පැනි එකෙන්, right? Your expected return. So this is your risk-free rate, and this is what the additional that you are expecting from the commercial bank. This thing, round kare. So let's say this is around 3%. So that means altogether as an investor, you are expecting 7%. And for the from the commercial bank perspective, this is a cost for their equity. This is what we call it as cost of equity, right? So this entire thing is this one. This 4% is this thing. Right, so this thing is the 7%, and this is a cost for the commercial bank, and this is the expected return of yours. I hope that particular thing is understood to you, right? Okay, let me repeat that again. So this is a very important part. Otherwise, if you don't get this to your mind, you can't go ahead, Lamai. Right? So I told you that if you go and invest in a government, definitely you can get 4% because the government is assuring you that we are going to pay 4% for your particular investment, even though it's treasury bill or treasury bill. We are going to give you that 4%. But what you're going to do is you're not going to invest in a government treasury bill or a government treasury bond. Instead, you are going to go and invest in commercial bank shares. You'll go and buy commercial bank shares, right? So when the government is assuring you that we are going to pay you this 4% under assure, right, under promise, right, even when there is not assuring, even they are not going to promise you the commercial bank, so that means there is a high risk. So when there is such a risk, right, when there is such a risk, right, so that means you are expecting more from the commercial bank, not the 4%. I don't want 4%. Even the government under assure they are going to pay me 4%. That means definitely something higher than 4% I want from you, commercial bank. So you need to pay me that. So that means something should comes here, and that should be equal to, let's say that if it is 8%, so that means this is 8%. This is the 4% risk-free rate, and this is what you need to find out. This is the entire thing. This thing. That means this is the 4% that you need to find it out. Right? I hope it's clear. By having that in your mind, so you know what is risk-free rate. Then we are coming to the next point that we need to know, that is the market risk premium. So what do you mean by this market risk premium? That means this RM minus, you can see this RM minus RF. So you already know what is this RF. That is the risk-free rate. This thing, again, you need to plot the same RF in here. I mean, you need to put the same RF in here. So what is this RM? RM is the market return. This is the market return. What do you mean by this market return? So if you go and invest in a all share price index, you know what is all share price index in the stock market? In the stock market, this is one of the proxies that you can use in order to identify the entire market return, right? Entire market return. ඒ කියන්නේ ඔයාලගේ තියෙනවනේ stock market එක. stock market එකේ market එකේ invest කරොත් ඔයාට හම්බ වෙන return එකෙන් ඔයා RF කියන්නේ ඔයා government එකේ invest කරොත් ඔයාට හම්බ වෙන දෙකේ අඩු කිරීම තමයි we call it as market risk premium. So market risk premium කියන්නේ we take the RM, we deduct the RF. ඔයා government එකේ invest කරන්නේ නැතුව, if you go and invest in the market, this is what we call it as market risk. The additional what you can get if you go and invest in the market other than the government treasury bill or a bond, RF, what you can get. So that is market risk premium. This is not this one. මෙන්න මේ කැලල. අර B කියන එක නැතුව මෙන්න මේ කැලල තමයි what we call it as market risk premium. Right? So that is your SPI. I think in your news also you might have heard the SPI is performing well. That is went high by this amount of basis points. Likewise, you might have heard, right? So what is this risk premium? How you can calculate the risk premium? You need to take the market return. Don't worry, in your questions you have the market return is there, so you need to calculate it, right? So what you need to do is, but you need to find out the market risk premium. So how you can calculate the market risk premium? You need to take the market return and then you need to deduct the risk free rate. Then you are getting the market risk premium. Don't worry, we'll do some exercise, then you can understand. This is the market risk premium. So what is the market risk premium? You take the market return and you need to deduct the risk-free rate, then you are getting the market risk premium, right? So this is it, market risk premium, right? Then you need to know company beta. What is this beta? This thing, this beta. I'll erase all this. So this one is the company beta, this thing. So you need to find out this. So you don't need to, memorize this thing. This is how you find out the beta, but don't worry. In your examination, directly the beta is given. But I'm just, I just put the equation for you, right? So this is how you can find out this beta value. Either you can go with this equation or this equation, but don't worry. I'm not asking you to calculate this beta because in the examination, it's already will be there. The beta will be there. So these are the three things that you need to understand. So what do you mean by this beta, right? So what is this beta, Lamai? Beta is the sensitivity of a stock returns to the returns of the market portfolio, right? Let's say you have invested in commercial bank. How sensitive the commercial bank's return to the market return? That is what we are going to calculate as the beta, this kind of a coefficient, right? This is what you're getting as the excess. So you have to multiply it by this beta value, what we call it as how much the commercial banks stock return, right? Sensitive, or the how much that from the commercial bank that we are getting, or how much the commercial bank stock return when you compare it with the market return. ASPI return එකත් එක්ක market return from ASPI return, when you compare it with your market return, how much you are getting for the commercial bank. That is kind of a sensitivity that we need to multiply. So when you are going to calculate the cost of equity, right, when you are going to calculate the cost of equity, this is the equation that you need to write, or you need to use. What we call this equation or this model, we call it as capital asset pricing model, or as in short we call it as CAPM model or CAPM model, right? So by using this model you can find out the cost of equity from the firm's perspective, but the same you can use in order to find out the expected rate of return. Expected rate of return, we call that word, or we are giving that word from the investor's perspective, but it doesn't matter, right? You can use this model or this equation in order to find out this cost of equity or the expected rate of return. But when you are going to calculate this cost of equity or as this rate of expected rate of return, you need to remember three things. That is your risk-free rate, you need to remember, right, which is the treasury bill or the treasury bond rate, which is the default risk-free security rate, or which the government is promising you that they will give you, right? And then you need to know the market risk premium. What do you mean by market risk premium? Market return minus the risk-free rate, then how you can get the market risk premium. That means how much excess that you can get when you compare it with the risk-free rate. And then you need to know this beta. This is the beta. So beta, this is how you can calculate the beta. So beta means the stock sensitivity of the stocks return. Stocks means that particular individual stocks return. It could be commercial bank, it could be Sampath bank, it could be any other bank. The sensitivity of stock return when you compare it with the all share price index return or the market return. The sensitivity of the stock returns when you compare it with the market return, right? So that is what you need to know. This is the cost of equity or the expected return. This is how you need to calculate. I hope it's clear. Okay, right. Hello, record. Right. I hope that is clear to you. Right. So moving ahead. So from the firm's perspective, the expected return is the cost of equity capital. And from the investor's perspective, I told you that that is the expected return, right? So this is the same thing which I have explained to you, right? So this is the formula of cost of equity, or as what we can call it as capital asset pricing model, or what we call it as, CAPM model or CAPM model, or we can, from the firm's perspective, we can call it as cost of equity, or from the investor's perspective, we can call it as what? We can call it as expected return or the expected rate of return. So what is this? This is the risk-free rate. This is also the risk-free rate. And this is the beta, right? And what is this thing? This is the market risk premium, right? And this is what? This is the cost of equity or the expected return, right? I hope it's clear to you. Right. Now we'll do a small question. Right. Example. So let me first read this for you. So this sort of a question will be there in your examination paper. So don't worry. So if you got the idea correctly, you can find the cost of equity, right? Suppose the ABC company has a beta of 2.5. I told you that the beta is already given. You don't have to find out the beta. And the firm is 100% equity finance. What do you mean by that? I told you when it comes to a firm, that firm can raise money using two ways. One way is they can issue stocks. That means they can go for equity and they can go for debt. So this is a company where they do not have debt, or they have zero debt, and they are 100% financed by equity. That means they are 100%, they have raised money by dividing the entire company into small stocks. So that is equity, 100% equity. That is what they mean by that. So what they're trying to enhance the fact that this company is 100% equity and there is no any debt involvement, right? So therefore only the cost of equity will be there, because if the debt is there, you need to calculate the cost of debt as well. Therefore, why they have given such a phrase here, 100% equity, that means the cost of equity is equal to the cost of capital. I told you the firm has two ways, or there are firm has two things that they can use if they do not have cash within them. So that is, they can issue equity and also they can go for a debt. So when the equity is involving, that is what we call it as cost of equity. But if the debt is involving, we call it as cost of debt. So here, since the company is 100% equity finance, that means the no debt is involving. That means there is no any cost of debt. And I told you that altogether the cost of equity and the cost of debt, what we call it as cost of capital. Cost of capital. So since here there is no any cost of debt is involving, because no debt, so that means your cost of equity is the cost of capital, or your cost of equity is equal to the cost of capital. I hope it's clear, right? All right. So assume a risk-free rate is 5% and the market risk premium is 10%, and they're asking from us what is the cost of equity. So first thing is, when you're given with such a question, the first thing is that you need to do is you need to write the equation, or you need to write the capital asset pricing model, or you need to write the CAPM model. So what is that? If you go to the previous slide, right? See, this is the slide. This is your cost of equity or the expected return, and this is the risk-free rate, and this is the market risk premium, and this is the beta. I think all the information is given. Only thing you need to is you need to plug these figures to this equation. So why the cost? So if the cost of equity is asking, that means you need to find out the cost of equity. Or I mean the cost of equity from the company's perspective. But if the expected return is there, that means you are just trying to find out that from the investor's perspective. So here, let's see first, what is the risk-free rate? That is 5%. Here, the risk-free rate is 5%. So that means we need to find out the cost of equity. So cost of equity is equal RF plus beta into RM minus RF. So this is RF, risk-free rate. This is the market return. So when you take the market return and deduct it by risk-free rate, we call it as market risk premium, and this is beta, right? So what is the risk-free rate? Risk-free rate is 5%. So the 5% is here. Plus market, what is the market risk premium? Market risk premium is given, that is 10%. That means market return minus risk-free is given, that is 5%, right? But we need to multiply it by beta. What is the beta value? That is also given, that is 2.5. That is 2.5. So what is the answer? 5% plus 5% plus 5% into 2.5. You need to add both these together. So 5% into 2.5, that is 12.5. So if you add these two together, 12.5 plus 5, we call that, the answer is 17.5. I think I'm correct. This answer is correct. So the risk-free rate is 5% and the market risk premium is 10%. Sorry. Market risk premium is, I'm really sorry. I'll do it again, right? So the cost of equity is equal to the risk-free rate plus beta. We call this beta or beta, right? RM minus RF, which is the market risk premium. So the risk-free rate is 5% plus beta value is 2.5 into market return minus risk-free rate, which is already given here, that is 10%. So what is the answer? 5% plus 2.5 into 10%. 2.5 into 10, which is 25. So altogether 25 plus 5%, altogether that is 30%. I hope it's clear. Right? This is nothing but you just have to, plug your given figures to this equation. That is what you need to do, right? Nothing new. They are just giving you all the information. You need to do is plug it. But in any case, sometimes they might not give you this market risk premium. Instead, they will give you market return. Now, let's say the market return is, let's say they have given the market return as, let's say, 15. Let's say the 15% market return is there. Now, let's say the market risk premium is not there. Suppose the ABC company has a beta of 2.5. The firm is 100% equity finance. Assume a risk-free rate of 5% and a market return. Now, let's say the market return is 15% is given. Find out the cost of equity. So, in this scenario, what you need to do is, again, you need to write the equation, because writing the equation is very much important, because you are getting a 1 point for writing the equation, right? Even though you don't know how to calculate, you don't know how to even plug your figures to the equation, just write the equation, you are getting a 1 point, right? So the cost of equity is equal to the risk-free rate plus beta into market return minus risk-free rate. So risk-free rate is equal to what? 5%, that is already given. And then beta is 2.5, right? Into, now the market risk premium is not given, only the market return. So you need to read carefully. Not the market risk premium, market return is there. So the market return is 15% minus risk-free rate is again 5%. Here 5%. Now you need to calculate. See, 5% plus 2.5 into 15 minus 5, that is 10%. Now see, what is the answer? 2.5 into 10, that is 25. Again, that is 30. Likewise, you need to calculate. See, if the market return is there, this is how you need to plug your values to your equation, right? I hope it's clear. All right. See, this is the answer. Even you can look into the answer. What they have done is, they have done the, do not mind what is written in here. Just think, remember, this is the cost of equity. This is the cost of equity, right? So RF plus beta into market return minus RF. So our risk-free rate is 5%, beta is 2.5, that is into 10%. So that means 2.5 into 10 is 25. 25 plus 5%, you are getting 30%. So this is the cost of equity of the firm, or this 30% is the investor is looking for by investing in such that ABC company firm. Is expecting 30% of return, at least 30% of a return, right? I hope it's clear to you. Okay. Right. අපි දැන් කතා කරන යනවා estimation of beta measuring market risk. දැන් මෙයාලා beta එක තියෙනවනේ, ඔයගලන්ට මතකද beta එක ගැන කිව්ව මොකක්ද beta කියලා කියන්නේ? Sensitivity of a stock's returns to the return on the market portfolio. මම මේක ඉස්සෙල්ලා explain kara. So what do you mean by this beta? Beta means sensitivity of a stock returns to the return on the market portfolio. That means you have the market portfolio. I'll explain you what is this market portfolio. So what you're going to do is, we are just taking the return of the market portfolio and we are trying to identify what sort of a sensitivity to our stock return when you compare it with the market portfolio's return. That is what we mean by beta. So we have something called beta. So what do you mean by beta? So we have the market portfolio return. I'll explain you what is this market portfolio. So what we are trying to do is, we are trying to calculate, or we are trying to see what sort of sensitivity is there to our stock return. Either it's commercial bank, either it's Sampath bank, whatever the individual stock return, what sort of a sensitivity is there for our one particular stock return when you compare it with the market portfolio return, the entire market return. Let's say the entire market return is 10%, but your commercial bank return is like 8%. So what sort of a sensitivity is there? Market at least if you invest in the market, you can get 10%. But by investing in the commercial bank, you can even get 8%. So now what we are trying to do is, what sort of a sensitivity is there in your individual stock return when you compare it with the market portfolio return. So for that, we need to know what you mean by this market portfolio. So what is the market portfolio? Portfolio of all assets in the economy. In practice, a broad stock market index such as the S&P Composite is used to represent the market in Sri Lanka views ASPI. So market portfolio means, Lamai, now I told you that individually we have stocks which are listed in Colombo Stock Exchange. We do have Commercial Bank, we do have Sampath Bank, we have John Keels, we have Abans, we have Singer PLC, we have other sort of, all the companies which are listed in the Colombo Stock Exchange. If you take it one by one individually, that is our individual stock return. But if you take it as a whole, entire stock portfolio, we call it as entire stock portfolio. That means, Lamai, in the stock exchange, we have Commercial Bank, we have Sampath Bank, we have Abans PLC, which is listed on Colombo Stock Exchange, we have Singer, we have John Keels Holdings, we have Keels, that means we have Ceylon Coal Stores, right? These all are listed in Colombo Stock Exchange. So if you take this one separately, this is your particular individual security stock returns. Ceylon Coal Stores, if you take the John Keels Holding separately, that is one particular stock return. If you take Aban separately, that is your one particular concern company's return. But if you take all the companies which are listed on Columbus Stock Exchange as a whole, right? What is the return? So what is the return if you take all the companies as a whole? We call it, what is the return? So even before you are going to the return, this entire stock as a whole, we call it as a market portfolio. Market portfolio, right? Individual wise, you have separate companies which are listed on Columbus Stock Exchange. We do have JKH, and JKH has a particular return. If you invested in Abans, there is a particular return for that. But if you take all the listed companies in the Columbus Stock Exchange as a whole, we call it as what? We call it as a market portfolio. And this market portfolio also generates a return. We call it as market return. That is what we have, denotes it as RM, right? So how we can calculate that? In Sri Lanka, we do have all share price index, but in some other countries they use something called S&P 500 likewise. But in Sri Lanka, we use, in order to calculate this market return, or in order to calculate the return of this market portfolio, we use all share price index. Did you get my point? Okay, so let me simplify it again. So what is this so now you can see what is the beta. If you take the John Keels Holding stocks, this is the stock return. But what is the return of the market portfolio? That is the SPA. So what you're trying to do is, using this beta, you're trying to see is individual wise your John Keels Holdings return sensitivity to the ASPI return, to the market portfolio. If you take Abans, you are trying to see what is the sensitivity of Abans returns when you compare it with the SPI return, right? So that is it. So market portfolio means entire market. You call it as a market portfolio. You have individual stocks, but all together you call it as market portfolio. So how you can calculate the market portfolio return? That is using, in Sri Lanka, all share price index, but some other countries they use uh, uh, S&P 500, likewise Standard and Poor's 500. Even in Sri Lanka also we have S&P 20, but we are not using in order to calculate the market return. So if you want to calculate the market portfolio return, you are using all share price index return. So what is the beta? Sensitivity of individual stock returns when you compare it with the market portfolio return or the SPI return. So right, I hope it's clear to you. Okay. Right. So now we are going to estimate the beta, right? So I told you that when it comes to this point, right, this is our beta, right? This is our beta and it's already given. So don't worry, even though I'm telling you that we are going to estimate it in the exam itself, I'm not going to ask you to calculate the beta. I'm very much sure that I'm going to give you the value of the beta. But anyway, right, here there is some, theoretical aspects which you need to know when it comes to this beta, Lamai. So that is why I have included the subtopic estimation of beta, because even though you don't have to calculate the beta in your exam, there are some sort of theoretical aspects that you need to know in behind that, right? So as I told you earlier, so this is the equation that I'm going to use when I'm calculating the beta. But don't worry, you don't have to calculate the beta using this equation, right? But here you can see that we have used this market return here. Market return is there, and this What is this? Variance. So that means why we are using the variance? In order to calculate the risk, right? So we are using the market risk here in order to calculate the here. What are the points that you can see? So they have calculated the beta. You don't have to calculate the beta, but just identify what sort of things that they have used in order to calculate the beta. So here this is, now this is M denotes for the market. So this is variance. So we are using variance in order to calculate what? In general, we are using the variance and standard deviations in order to calculate something risk. So this is market risk. So we are using market risk, right? And then what else? Here you can see that there is a return, individual assets return, right? So the covariance is involving here. So that means some kind of a relationship that we are looking. This is the individual stocks return. This is again the market return. So that means we are looking the returns of both the market and the individual. So that means we are looking for some kind of a covariance. That means some kind of a relationship over here, right? So likewise, you can see both the individual stock return and the market return is both are involving. That means the risk, return, everything is involving when you have to calculate the beta. Market risk, market return, individual stock risk, individual stock returns. So all this individual return risk, market risk return, all the things are involving in here. Did you get my point? You don't have to calculate the beta value, but just remember that, but get that into your mind that when you have to calculate the beta, right, you need to use the individual, that means commercial bank or Sampath bank return and risk, as well as the market return and risk. Okay, right. So having said that, when we are calculating this sort of a beta, there are some problems, and also in order to overcome those problems, we need to go with some solutions as well. So there are three problems when you are going to calculate the beta. What are those three problems? First thing is that betas may vary over time. That means when we, even though we have calculated this beta is vary over time. That means beta could be changed over time. So we are calculating beta for this year, but next year again there could be another beta. Why that beta is vary? Because I told you we are taking the market risk return, individual stock risk return. So when those sort of things changing, market return changing, market risk is always changing, individual stock returns changing, individual risk is changing. So therefore when those aspects are changing, definitely your beta also needs to be changed. So one particular problem is that you cannot go ahead with the one constant beta value, because the beta is always changing. So that is a one problem, right? So the second one is the sample size may be inadequate. So in order to calculate this beta, we are using the market. I know I told you that market risk return. So sometimes I told you that in the market portfolio there are individual companies there, right? A commercial bank is there, then the Sampath bank is there. But sometimes when you are using this market portfolio, sometimes the sample that you are taking in order to calculate the beta, sometimes it won't be enough. So that is also one sort of a problem, right? Then the second thing is betas are influenced by changing financial risk and business risk. I told you that in order to calculate the beta, you need to have the individual companies. It could be commercial bank, it could be Sampath bank, it could be John Keel's Holdings. I told you that we are using individual companies, risk and return, right? So therefore, when each of the companies financial, I'll explain you what are those financial risk and business risk in later slide. But here, just remember when the financial risk and the business risk of each of the companies changing, beta is also changing. That is true, right? Each of the companies financial risk, and I told you that each of the companies risk we need to take. So when each of the companies financial risk and business risk is changing, definitely it's influence to the beta. So that is also another problem. So there are three problems when you are going to calculate the beta. But calculating the beta using the equation is very straightforward. You need to plug your values to here, right? Nothing else. But I don't want you to calculate the beta, but you have to identify, or you need to understand what are the problems and what sort of solutions are there. So there are three problems. The first problem is that beta is not constant over time, so it's vary over time. And the second thing is the sample size that we are using in order to calculate the beta could be not be inadequate or not enough. Or the third one is, since we are taking the individual company's risk, right? That means risk is altogether the financial risk and the business risk. So when those financial risk and business risk is influencing the when the financial risk and the business risk is changing, it influence the beta, and it influence the beta, and the beta could be changed due to that, right? So these are the three problems, but we need to come up with some solutions, right, for these problems. So the problem 1 and 2 above, what are the 1 and 2 here? So now we are talking about the solution. So problems 1 and 2, that means the beta vary over time and the sample size is not adequate. We can solve it using a very good statistical technique or a statistical model, right? So when you can solve this. Beta may vary over time, and you can uh, come up with the sample size may be inadequate. You can solve it using a very good statistical model. That's why I'm telling you that I don't want you to calculate the beta. So you, if after you are using a very statistical technique, yes, you can solve these two. And the problem 3 can be lessened by adjusting for changes in business risk and financial risk. We know that this one, coming to this problem. So we know that in each of the companies, they do have a financial risk and business risk. But after you adjust this financial risk and business risk, after you doing something to this financial risk and business risk, we can solve this beta, right? And the third thing, look at average beta estimates of comparable firms in the industry. That means rather than using, in order to calculate each of the stock return, rather than using the each of the firm's beta, you can come up with the industry beta. That means you can use industry beta. ඒ කියන්නේ එක එක කම්පැනි වලට එක එක බීටා එක යූස් කරන්නේ නැතුව අපි හිතමු මැනුෆැක්චරින් ඉන්ඩස්ට්‍රි එකටම එක බීටා එකක් යූස් කරනවා. ඒතර මැනුෆැක්චරින් එක එක කම්පනීස් වලට එක එක බීටා ඕනේ නැහැ. We are just using a one particular beta for the entire industry. We are not going by each of the companies in the manufacturing industry. Each of the companies, we are not using an individual beta. Instead, we can use one particular industry beta, comparable industry beta. Did you get my point? So when it comes to this beta, there are three problems involving. Betas may vary over time, which is not constant. And also the sample size may be not enough. It's inadequate. And also the third one is betas are influenced by each of the businesses, each of the firm's business risk and the financial risk. But I'll explain you what are those financial risk and business risk in later sides. And we do also have solution for the first and second one. Yes, we can use a good statistical model or a statistical technique. But for the third one, after you can adjust to the business risk and financial risk, we can solve this third problem as well. And for the every problem, when you can use a one particular industry beta rather than calculate the beta for each and every firm you are taking. If it is the commercial bank, don't try to calculate a one particular beta for that. Even let's say we are taking banking industry. When it comes to banking industry, we have lot of banks: Sampath Bank, Commercial Bank, BOC Bank, People's Bank. What else? There are lots of banks in our country. So rather than calculating Sampath Bank beta, Commercial Bank beta, then People's Bank beta, BOC beta, use a one beta for one beta for entire industry, banking industry. That is what the third solution is. I hope it's clear to you, right? Okay, right. So right. So now let's see what is the stability of beta, right? I'll read this for you first. Most analysts argue that betas are generally stable for firms remaining in the same industry. That's not to say that a firm's beta can't change. Changes in product line, changes in technology, regulation, changes in financial leverage, right? Okay, so let me explain this to you. The first thing is, just forget the topic, subtopic, stability of beta, right? So first thing is, most analysts argue that betas are generally stable for firms remaining in the same industry. That means, Lamai, when it comes to beta, right? When it comes to beta, we can have two betas, right? One is firm beta and the other one is industry beta, right? So what is this beta? When it comes to this beta, I told you what is the beta. Beta is the sensitivity of the stock returns when you compare with the market return. So that is the beta. No? So we can have a sensitivity of a firm's return to market return, or as the sensitivity of an industry to the market return. We can have those two betas. Either you can have for each of the firms, for each of the company beta, you can calculate, or either you can calculate a beta for the entire industry, right? So there can be two betas. So most of the analysts, right, most of the people who are doing this analysis, they are just saying, or they are just arguing that the firms which are in the same industry, that they can use a one beta. That means, now let's say if you take as my previous example, let's say the commercial bank, Sampath Bank, People's Bank, Bank of Ceylon, what else? Hatton National Bank, HNB Bank. These all the firms are belong to a one particular industry. That is bank. That is banking industry. So what these analysts argued that rather than using separate firms beta, why all can't use one particular banking industry beta in order to calculate the cost of equity? That is what they're saying. So why we are using this beta? So we are using this beta in order to calculate the cost of equity. So why can't we use a one particular industry beta rather than calculating the beta for each of the company? Why can't we use a one particular industry beta? Because all these companies are belong to one industry. So that would be easy for us to use a one industry beta rather than calculating each of the companies beta. So they are just telling that us to use the same industry beta. But what the thing is that that is not always true. We can't always use the same industry beta for each of these company. Why? Because of these things, right? Sometimes when you compare the industry with your concerned firm, sometimes the production that you are doing within your company might be different. Let's say there are when it comes to manufacturing firm. Now let's say you are in the manufacturing industry. There could be A, B, C, D, E. So what the analysts are saying to us is, rather than using each of the A beta, B beta, C beta, D beta and E beta, why you are not using a one manufacturing industry beta? So the problem is, sometimes the A's production might not be same as the B's production, even though they are into manufacturing industry. Even though we are classifying all these companies under manufacturing industry, A is into, let's say, food manufacturing, but C is into t-shirt manufacturing, but E is into coffee manufacturing. So the risk affecting for the food manufacturing is not same as the risk which is affecting to the coffee, or the risk which is affecting the t-shirt or the garment company is not same as the coffee risk which is affecting the coffee company. So but they are in the manufacturing industry, right? So that is what I'm saying. So the production could be changed. So therefore we cannot use one particular industry beta for each of the company, because sometimes the production line or the production could not be same. Therefore we cannot use the industry beta for each of the companies, because the production line is not same. And sometimes the technology that they are using, right? Sometimes the technology, the A's technology is sometimes not same as the C's technology. So therefore the risk affecting, the returns affecting for the A and C is not same due to this technology. Sometimes the regulation, so the regulations affecting for the A is not same as the C. The regulations affecting for the coffee manufacturing coffee is not same as the garment, right? Likewise, the regulations could be changed. And sometimes the financial leverage. I'll explain you what is this financial leverage, but just keep that in your mind. The financial leverage changes in the A company is not same as the C company. So therefore, even though that we can use the same industry beta, if the firms are doing the same as the industry, we can use the same beta. There is no any doubt. But sometimes the production line could be changed. Sometimes the technology is not same. Sometimes the regulations are different. Sometimes the financial leverage are different. Therefore, we cannot go with the same beta. Therefore, sometimes we can go for adjustments and we can use the same industry beta, but sometimes we cannot use the same industry beta. That is what I want to say. Sometimes the analysts are saying, why can't you use the same industry beta for all of your firms, each of the firm? That is why we can't use, because of these points, because of these facts, right? But sometimes we can do many adjustments and we can use the same beta, but sometimes we can't even do the changes and use the same beta due to some facts, right? Okay, I hope it's clear to you, right? Okay, so this is again, it is frequently argued that one can better estimate a firm's beta by involving the whole industry. If you believe that the operations of the firm are similar to the operations of the rest of the industry, you should use the industry beta. They are telling you, if your firm's operations are same as the industry, please use the industry beta. You don't need to calculate the firm's beta. If your firm's operations are exactly the same the industry, why you're calculating a separate beta for that? Please use the industry beta. And then if you believe that the operations of the firm are fundamentally different, see, fundamentally different, the industry is the garment, but your company is coffee, fundamentally different. So use firms beta. At that point, use firms beta. But don't forget about the adjustments for financial leverage. Definitely, you need to adjust for financial leverage when you are using such betas, right? I'll explain you what is this financial leverage, right? So don't get confused, right? So what they're telling is, when you are there, I told you that there are two type of betas: industry beta and a firm beta. So if your firm is doing exactly the same as the industry, please use the industry beta, right? So in your examination, if I ask you like this, so the industry beta is also given and the firm beta is also given, and I'm giving under a sentence that the firm is doing exactly the same as the industry, then don't use the firm beta, use the industry beta, take the industry beta, right? Again, in your exam paper, if I give you the industry beta and the calculated firm beta, don't mind that you don't need to calculate the industry beta and the firm beta. What I'm telling you is that in the exam, if I given you the both the firm beta and the industry beta, and under that if I tell you that the firm is exactly the same as the industry beta, don't go with the firm beta. For your cost of equity calculation, use the industry beta. But if I tell you that the firm is doing fundamentally different to the industry, then use the firm beta, right? But make sure to do the financial adjustment. Don't mind, you are not getting to do this, but when you are calculating, but in general, when you are calculating the beta, you need to adjust for the financial leverage. Even though you are using the industry beta or the firm's beta, you need to calculate for you need to adjust for the financial leverage, right? I hope this is clear to you. So that is using the industry beta and the firm's beta, right? Okay, I hope it's clear to you. Right. So now let's talk about what are the determinants of beta, or else we can call it as what determine the beta. When you are going to calculate the beta, don't worry, I'm saying it again. I'm saying it again. You don't have to calculate the beta in your exam paper because the beta will be already calculated, right? So don't worry, but we need to talk about these things: what determines beta, and when you are going to calculate the beta, what influence the beta. So those sort of things you just generally know, even though you don't have to calculate the beta, right? So when it comes to beta, so now we are going to study, or now we are going to learn what sort of factors affect the beta or what determine the beta, right? So we'll see what are those factors. So basically there are two main factors affecting for beta, or there are two main factors which determine the beta. The first thing is that is business risk, and the other one is financial risk, right? So basically there are two things. First thing is business risk and the second thing is financial risk, right? So under the business risk, again we can have 2 points. The first thing is cyclicity of revenues and the second one is operating leverage. And when it comes to the financial risk, we can have financial leverage, right? Don't worry, we are going to study one by one what is this cyclicity of revenue, and what is this operating leverage under business risk, and what is this financial leverage under the financial risk. So don't worry, we'll do, right? We'll discuss. Okay, so when it comes to business risk, right, so you can get the meaning from the word itself, business. So any risk which is relates to its business, right, or its operations of business, so nature of business, right, so that is something related to its operations, business activities, right. So based on what sort of activity that, or what sort of a business that that particular company is engaged in, right, so that affects its beta, right. So under that we are going to discuss the cyclicity of revenue and operating leverage. So you can you can just think that cyclicity of revenue and operating leverage is something relates to the business risk. And when it comes to the financial risk, you can think about that is something relates to the financial, in the company's financial, whether the company is into whether the company has invested in debts or equity or some kind of like that, something relates to its finance, right, something relates to its finance, not relates to its operations or the business activity, right. So we are going to talk about the determinants of beta using these two aspects. One is the business risk and the other one is the financial risk, right? Okay, we'll see in depth what are those, right? So moving ahead, going to the second, the cyclicity of revenue, or the first point under the business risk, that which is cyclicity of revenue. So when it comes to the cyclicity of revenue, right, this is very much important. So what you are going to learn here is basically the business cycle, right? Do you know, or do you have you heard this business cycle before? What do you mean by this business cycle? So I'll first read the slide for you, then I'll simplify it, right? We'll go one by one sentence by sentence, right? Highly cyclical stocks have high betas. Highly cyclical stocks have high betas. Don't worry, I'll explain. Empirical evidence suggests that retailers and automotive firms fluctuate with the business cycle. Transportation firms and utilities are less dependent upon the business cycle. Note that cyclicity is not the same as variability. Stocks with high standard deviation need not to have high betas. Movie studios have revenues that are variable depending upon whether they produce hits or flops, but their revenues are not specifically dependent upon the business cycle, right? Okay. Now let me explain. Right. So I hope that you know the business cycle, right? So if I draw the business cycle, right? So you all can see that this is the business cycle, right? Like this is the business cycle, right? So here you can see that you have peaks, right? And here again a recession, and here there are troughs, and here again a growth, and here again a peak, and again a recession, and again a growth, trough, and again a peak. So this is kind of we call this as, this is kind of a business cycle. So this is the business cycle. So many of the companies, they face this business cycle, right? So I think the one of the business cycles I have given here, right? You all can find these business cycle, right? So I think not this. Here, see, this is a business cycle. See, this is what I have drew earlier. See, like this. There is a, this is the peak, and there is a downward trend here, and then again a trough. Trough is the yatamatika, yana, right? Then again a upward trend, or we can call it as a growth, and then there is again a peak, and again a downtrend, or we can call it as a recession, right? And again a trough, and again a uptrend, right? So likewise, every company, every country, they do have this kind of a business cycle, right? So what are the phases of the business cycle? There are four phases basically: the recession, the downward trend, growth or the upward trend, or as the peak, and then the trough, right? So likewise, there are four phases that we can see in a business cycle, right? So why this business cycle is that much important? Because here highly cyclical stocks have high betas. That means if your company right? If your company has a high business cycle, or else if your company is, going according to the business cycle, if your company is highly sensitive to this business cycle, we call this, we can say that in those companies there is a high beta, right? So I told you that even individual companies we can have an individual beta, but if in the industry, if all the companies are, if in the industry all the companies are same, right, or homogeneous, we can have an industry beta. But if any case, if one of the companies is their operations or their business activities is different from the industry, then they need to use a individual beta, right, their own individual beta. So when it comes to these individual betas, right, if a one particular company is highly sensitive to this business cycle, if they are going with this business cycle, that means if the, let's say now, in a business, if a business now, let's say the most probably the retailers and automotive, right, let's say the country is in now, let's say in this kind of a situation, recession. So now in the country we are in a recession situation. So in that sort of situation, most of the time the retailers and the automotive companies, I mean automotive vehicles companies, they do face with, or they do fluctuate with this business cycles. When the country is in down, the business are also down, so the country's business cycle is also in a downward situation. So that mainly impact to their businesses. So mostly those are retailers and automotive. So these automotives and retail companies are very much fluctuate with this business cycle. So if there is any company, not only the retailers and automotive, if there is any particular company which is, highly sensitive to this sort of business cycle, or if any sort of a business activity is highly fluctuate with its business cycle, right, we can have high beta in that particular company, high beta. But if there is any particular company is not sensitive to the business cycle and which is not fluctuate with the business cycle, we can have a very low level of betas, right? So when it comes to the utilities, when it comes to transportation, even though it's a recession or not, transportation should be there. Like අපි කියන්නේ මූලික අවශ්‍යතාවයන් ටික සෞඛ්‍ය සේවාව, ප්‍රවාහනය, අධ්‍යාපනය වගේ මූලික අවශ්‍යතාවයන් they are not, fluctuate with the business cycle. But there are some companies which are fluctuate with the business cycle, but there are some other companies which are not fluctuate with the business cycle. So if any company is highly fluctuate with the business cycle, right, we can say that those companies have a high beta. But if any company is not sensitive to the business cycle, or if any company doesn't have a, if any company is, less dependent upon the business cycle, like transportation or utility companies, electricity, water, transportation, right, education, health sector, so these are not, very much dependent on the business cycle. Therefore we can say that those companies have a very low beta when compared with the retailers and automotives, because retailers and automotives very much, sensitive to the business cycles, right? So that is the first thing, right? So you can see that cyclicity of revenue is very much impact to the beta. You know that the beta is determined on the cyclicity of revenue or the business cycle. But here again there is a one sentence given here. Note that cyclicity is not same as variability. Stocks with high standard deviation did not have high betas. What do you mean by that? This cyclicity means not the standard deviation or not the variability. Sometimes companies is facing a variability, or we can measure it using the standard deviation. Sometimes there could be, when it comes to the movies, right, movie studios, right, what they're going to do when it comes to studios, they are going to produce films, they are going to produce movies. But sometimes, irrespective of the business cycle, right, there is no any connection to the business cycle, irrespective of the business cycle, sometimes their movies gonna be hits, but there could be some flops as well. කියන්නේ සමහර movies තියෙනවා ඒ business cycle එක හින්දා නෙමෙයි. සමහර movies එළියට දැම්ම ගමන් හොඳටම hit වෙනවා. සමහර ඒවා නෑ flop එකක්. ඒ කියන්නේ සාර්ථක නෑ. That is not because of the business cycle. That is because of the variability of that particular company. So by using this variability, right, or the standard deviation, we cannot say that particular company has a high beta. Because why? Because those movies are hit or flops. That is not basically due to the business cycle. That is due to the variability of those businesses. That movie studios could face to that sort of a variability based on each of the movies or the productions, right? That is not based on the business cycle, right? Therefore, you need to correctly identify whether this particular company is vary, or whether this company is dependent because of the business cycle or because of the variability. So if any sort of a company is dependent or determined based on the variability, we are not going to see whether that particular company has a high beta or low beta. We are only concerning about high beta or low beta based on this business cycle. I hope it's clear. So if any company is very much dependent or very much sensitive or very much fluctuate with the business cycle, we can say that those companies have high betas. Example, retailers and automotive. But if any sort of a company, they do not vary with the business cycle or not fluctuate with the business cycle, or they are less dependent on the business cycle, we can call them as they have low betas, right? Like transportation firms, utilities like water, electricity, right? Education, health sector, those are having a very less beta, right? So now you can see, so one of the determinants of the beta is that cyclicity of revenue. So cyclicity of revenue is comes under the what? Comes under what? Business risk, right? I hope it's clear. Now let's have a look onto this operating leverage. What do you mean by this operating leverage, right? So now we are done with the business cycle. Now we have to look what is this operating leverage, because this operating leverage is also one determinant of the beta, and it comes under the business risk as well, right? So the degree of operating leverage measures how sensitive a firm or project to its fixed cost. So what do you mean by operating? Now you know, Lama, when it comes to operation, now let's say there is a particular firm which which is into the garments. Let's say they're doing their production garments, so that means they're manufacturing t-shirts. So when they are going to manufacture t-shirts, relates to the operating, right? You can divide the cost as fixed cost and variable cost. You know what are the variable costs? The cost which varies upon the production or varies upon the manufacturing, right? So if there is no any production, that means no variable cost. But fixed cost means the cost is already there. We have already incurred that cost. Let's say the building. Let's say the building, we have to anyway pay let's say the rent is the fixed cost. Even though we are not going to produce any of the t-shirts, definitely we need to pay for the rent. Even we don't get any of the orders, but irrespective of that, we need to pay the rent for that particular building. Even let's say the electricity, right? Electricity, let's say electricity and water, even though you're not manufacturing, you need to pay for the electricity, right? You need to pay for the water, right? If you're using water, if you're using the electricity, that is not, we can say, sometimes we can say that electricity and water is semi fixed cost, right? But anyway, we can say that sometimes when the production is goes on, only the electricity will be there for the machines and for the lights, I mean the current you are using. Sometimes it could be, but the depreciation is also a fixed cost, right? And the good example is that rent, building rent. Even though you are going to manufacture t-shirts, even though you are going to produce t-shirt or not, definitely the building rent you need to pay. So that is kind of a fixed cost. But when it comes to the variable cost, cost is kind of, it varies according to the production. If there is no any production or a manufacturing going on, you don't have to pay any penny, any rupee for the variable cost, right? Example, raw material cost is a variable cost. So that is operating cost we are going to talk about under is operating leverage, right? So degree of operating leverage measures how sensitive a firm to its fixed cost. What we are going to see is how the company is very sensitive to its fixed cost, right? That kind of building rent, how much it's sensitive to it. Operating leverage increases as fixed costs rise and variable costs fall, right? That means we are going to see when your fixed cost, right, is increasing and the variable cost is fall, we're going to say that operating leverage is high in that particular company, right? High in that particular company. So it's also kind of a risk, Lama. When your variable cost is going low and your fixed cost is high, we can say it's kind of a risk. Now, early also, Lama, see, we are going to talk about the business risk. right? It's kind of a risk which determines the beta, because we are going to see the beta, the sensitive of the market return to that particular company. So in other way around, we are going to see the risk as well. So now we are going to see what determines the beta, what sort of risk, right? So now let's say business risk. First, we are going to see the business risk. What causes the business risk? First thing is cyclicity of revenue. So if one particular company is going according to the business cycle, that means there is some sort of a risk, right? Because if there is a recession, definitely our company is facing a recession too. Likewise, so there is kind of a, kind of a risk in there when your company is going, or when your company is moving according to the business cycle. But if your company is not very much dependent on the business cycle, that we can say that the risk is very much lower, right? So the second thing is operating leverage. So if a company is having a high operating leverage, that is also kind of a what? High risk limit. That means you are very much dependent on your fixed cost, operating fixed cost. Your operating fixed cost is higher than the variable cost. Your, we can say that operating leverage is high when your fixed cost is high and your variable cost is low. Hope it's clear to you, right? See here, operating leverage increases as fixed costs rise and variable costs fall. Operating leverage magnifies the effect of cyclicity on beta. The degree of operating leverage is given by, so this is how we can calculate the degree of operating leverage. This DOL denotes the degree of operating leverage. So we can say the difference of earning before interest and tax, the EBIT is stands for earning before interest and tax, divided by earning before interest and tax, and multiplied by sales divided by difference of sales. Right? Don't worry, we are going to do a calculation. Then you can calculate the degree of operating leverage. But what I want to express here you is that operating leverage means how much your company is sensitive to its operating fixed cost, or any of the project or your company, how much it's sensitive to your operating fixed cost. So operating leverage is high when your operating fixed cost is high and variable cost is less. So that means your company is much rely on the fixed cost than the variable cost, right? So that is kind of a risk in there. So when your company is having a high operating leverage means your company is kind of facing to a high risk. Your company is going towards the risk, right? So therefore that when your operating leverage is high, that means you are facing a high beta. Likewise. Okay, so degree of operating leverage is equal to the difference of earning before interest and tax divided by earning before interest and tax multiplied by sales divided by difference of sales, right? I hope it's clear to you. Now let's do a calculation and see. Okay. Okay, so now let's do this question, right? So what here we do, what is now we need to do? We need to calculate the degree of operating leverage, degree of operating leverage, right? So how can we calculate the degree of operating leverage? We know the equation given in the earlier slide was delta earning before interest and tax, earning before so earning before interest and tax, delta, and divided by earning before interest and tax. We need to multiply it by sales. Don't worry about my letters because today my mouse is not working properly. Sales divided by delta sales, right? So now let's calculate. So this is degree of operating leverage, right? So what is the delta EBIT? Delta earning before interest and tax. So in this question, here there are 2 years given, 2018 and 2019. Okay. And the sales figures and the earning before interest and figures is given. So, but we need to calculate something called delta earning before interest and tax. So delta earning before interest tax means the difference between the earning before interest and tax. So how can we take that? So 2018 figures are there and 2019 figures are there. So how can we calculate the difference? 500 and 200 difference. That means in the year 2018, right? In the year 2018, the earning before interest and tax was 500, but in the year 19 the earning before interest and tax has become 200. That means the difference. So 500, that means 200 minus 500, because now we are in the 2000 year 2019. So 200 minus 500. So that means what? We are getting minus 300. Minus 300, right? So this is what? This is our difference of earning before interest and tax. Minus 300, right? And then we need to divide it by earning before interest and tax. So we are calculating for the year 2019. So the 200 should be our earning before interest and tax. So we need to take 200, right? So this is our this figure. Delta earning before interest and tax divided by earning before interest and tax. So that means we need to take the difference between the earning before interest and tax. That means we are taking 200 minus 500. So that is minus 300. Then we need to divide it by 200. What is the 200? 200 is the 2019 figure, earning before interest and tax. Now we are moving to the sales figure. That is also same. So we are taking the sales figure of 2019. I'll write it here. So that is 600. Right? 600 divided by what? The delta sales. Delta sales means the difference between the sales figure. 2019, the sales figure is 600, but in 2018, the sales figure was around 1000. So that means 600 minus 1000. That means minus 400, right? Isn't it? Minus 400. So I'll clear all this. I'll take a text and write. So here, what is first we need to take the delta bit, right? That means the difference of earning before interest and tax divided by earning before interest and tax. That means the difference between earning before interest and tax means 200 minus 500. That means minus 300 divided by minus 300 divided by earning before tax is for the 2019 is 200, right? And we need to multiply this entire thing by what? Sales for the 2019 is 600 divided by delta sales. Delta sales is how much? That is 600 minus 1000. In year 2018, the sales figure is 1000. So that means the difference is minus 400. That means 600 minus 1000, that is minus 400, right? So now you need to calculate this. So now let's calculate it and see. Uh, 300 divided by 200, we are getting 1.5. So 1.5 into 600, this should be minus, I forgot, this should be minus, into 600 divided by 400, that is again 1.5. That means minus 1.5. Is it right? Difference between the earning before interest and tax is 200 minus 500, that is 300, minus 300 divided by 200, and the sales figure is 600 divided by the difference, that is 400 minus 400, right? So 300 divided by 200 is 1.5, but it should be minus. Again, the 600 divided by 400, that should be 1.5. Again, it should be minus 1.5. So minus 1.5 multiplied by minus 1.5, it should be plus 2.25. Even you don't have to put the plus sign here, right? So the degree of operating leverage should be 2.25, right? I hope it's clear. So in this company, right, in this particular company, the operating leverage is 2.25, right? Okay, so that means when it compares to your when it compares to your total cost, the fixed cost is bit higher than the variable cost, right? Because it's 2.25, 2.25, right? If it is equal, it should be 1, but even 2.25 bit more higher than 1. So that means fixed cost is bit higher than the variable cost, right? Okay. So this is just a graph. So you can here see operating leverage increases as fixed cost rise and variable cost fall. I told you that your operating leverage is increases when the fixed cost is rising, right? So here first see, look into this red color line. So the fixed cost is around here and this line is the total cost, right? So variable cost should be in like this, right? So the variable cost, if I draw the variable cost, right? So variable cost should be like this, right? So this is the fixed cost, this is the variable cost. So total is cost is this line. But now see, right? I hope that you all can see that earlier the fixed cost around was here. Now let's say it's around 5 rupee 5. But now see the fixed cost is around here, right? That means the fixed cost has been increased. So therefore the total cost is also increasing. That means your what? Your what? Your total cost is increasing. That means your fixed cost is also increasing. That means your operating leverage is increased, right? I hope it's clear. So this is in, if it is 5, let's say in here it's like 20, let's say around 20 here. So see, this red line is the fixed cost and this horizontal line is the fixed cost, and this green color line, that is also the horizontal line, that is also your fixed cost, that is around 20. So see the total cost now here around like here, and your variable cost might be in here like this, right? See how the fixed cost is increasing. So when your fixed cost is increasing, your operating leverage is going to increase, right? So that is what I wanted to say here. Okay, so we are done with the operating leverage. Now we'll move to the financial leverage. Okay, now look into this financial leverage, right? See financial leverage. So here financial leverage, how we can calculate the financial leverage? See, the percentage change in earnings available to common stockholders associated with given percentage change in earning before interest and tax. So here see, now earlier look into this. Earlier we have taken only the earning before interest and tax and the sales. But when it comes to the financial leverage, how we are going to calculate the financial leverage? See, you are taking the earning per share and the earning before interest and tax. That means you are taking the difference between earning per share divided by that particular year earning per share multiplied by earning before interest and tax divided by the changes of the earning before interest and tax. You know that this is the division. When you make it a multiplication, you need to make it upside down, right? Now you have to divide the entire difference of EPS divided by EPS by the entire this thing. But you know, when we put it as a multiplicative, you know, earning before interest and tax difference between the earning before interest and tax. So that is it, right? So now we are going to see the financial leverage. So how can we calculate the financial leverage? So you know what is this financial leverage? So that means we are done with the business risk. Now we are coming to the financial risk. So under the financial risk, there is only one thing that you need to know, that is financial leverage. So how can you calculate the financial leverage? You are taking the difference between the earning per share divided by earning per share multiplied by earning before interest and tax divided by the difference of earning before interest and tax. Okay, now with the given information here, now let's calculate the earning per share and the uh, now let's calculate the financial leverage, degree of financial leverage. So DFL, it's denotes by the degree of financial leverage, right? Okay, now let's calculate, right? So how we calculate degree of financial leverage is equal to, can't remember the equation, that is delta EPS divided by EPS. Delta EPS divided by EPS. Sorry, delta EPS divided by EPS. Delta EPS divided by EPS, right, multiplied by delta EBIT, no, EBIT divided by delta EBIT. Delta EBIT divided by EBIT, EBIT divided by difference of earning before interest and tax. I hope it's fine, right? So degree of financial leverage, how can you calculate? How can you calculate? That is the delta. That is why I have wrote it here as difference. The difference of EPS divided by EPS multiplied by earning before interest and tax divided by difference of earning before interest and tax, right? It's correct, right? So you need to take the difference of EPS divided by EPS multiplied by earning before interest and tax, because when now it's a division here. But if you are going to multiply it, you have to write it the other way around. That means you need to take the earning before interest and tax, then you need to divide it by difference of earning before interest and tax. Right, now let's do the calculation. Right, so how can we do the calculation? So we are taking the difference of EPS. So in 2018, the earning per share or the EPS is 10. And in 2019, the earning per share is 3. So that means 3 minus 10. So 3 minus 10. That means how much? 3 minus 10 mean what? That is the difference. That means minus 7. That is the difference of EPS or the earning per share divided by 2018 earning per share, that is 3, right? Then you need to multiply that by earning before interest and tax, that is in 2019, that is 200, divided by difference of earning before interest and tax, that is minus 300, right? So now calculate and see what is the degree of financial leverage. So 7 divided by 3, that is 2.33 minus, right? Then you need to divide it, so you need to multiply it by 200 divided by 300, that is 0.66. 0.66. So that means you are getting the answer as, that is also minus. So minus into minus, you are getting positive answer. So 2.33 multiplied by 0.66. That means you are getting as positive 1.54 approximately. So this is your degree of financial leverage. What is your degree of financial leverage? That is 1.54, right? So what we have done here was what? If I go to the right, so what we done here was, we have taken the delta EPS divided by EPS multiplied by earning before interest and tax divided by difference of the EPS. So the EPS was, the difference of the EPS was 3 divide 3 deduct, we deduct the 3, we deduct the 10 by 3. So we are getting minus 7, and we need to divide it by 2019 EPS, that is 3, and multiplied by 200 divided by minus 300. How did you calculate the minus 300? That is 200 minus 500, because we need to get the difference. So that means you need to multiply this minus 2.33, that is 7 divided by 3. You are getting 2.33 multiplied by 200 divided by 3, that is 0.66. So if you multiply these both minus marks, 2.33 into 0.66, you are getting 1.54 positive answer. Right? So this is your degree of financial leverage, right? And if you think that, right, if you go to here, I can't remember what did you get as degree of operating leverage, right? But if you want to find out, right, if you want to find out, Lamai, the degree of total leverage, right? No, what we have calculated is that we have calculated the degree of operating leverage and degree of financial leverage. But if you want to calculate the degree of total leverage, what you need to do is, you need to multiply both the degree of operating leverage and degree of financial leverage. That means this, right? let's say you want to calculate degree of total leverage. That means the total operating leverage and the financial leverage. So if you want to calculate the degree of total leverage, that means the degree of operating leverage uh, into the degree of financial leverage. That means degree of operating leverage into degree of financial leverage. What you need to do, you need to simply the multiplication. First, you need to find out the operating leverage. Then you need to find out the degree of financial leverage. Then if in the examination, if I ask you to calculate degree of total leverage, don't get confused. What you need to do is simply you need to take the degree of operating leverage because the answer is already there because you have calculated. And then you need to take the answer of degree of financial leverage. Again, don't get confused because you have already calculated the degree of financial leverage. Then what you need to do is you need to multiply both these two. Then you're getting the answer as degree of total leverage. Right? I hope it's clear. Here I'm not calculating it because now I can't remember the answers of the degree of operating leverage and degree of financial leverage. But nothing new, just you need to multiply both these two answers. Okay? So that's all about it. Okay. Right? Right. So here, this is kind of, summary what we have talked about, but I think I haven't talked about the financial leverage much. I'm just only show you what is this equation, how to calculate the degree of financial leverage. So let me bit explain about you what is this financial leverage in this slide. Okay. Right. So I have explained to you what is the operating leverage. Operating leverage is when it comes to here refers to the it refers to the sensitivity to the firm's fixed cost of production, right? Refers to the sensitivity to the firm's fixed cost of production. When it comes to the cost of production, when it comes to the production, I told you that there are two types of cost, variable cost and fixed cost. So operating leverage means how much your fixed cost when compared to the variable cost. But when it comes to the financial leverage, I told you that it's all about the financing, right? It's all about financing, whether you have investing using debt or equity. That is financial leverage, right? But there is some sort of fixed cost and variable cost as well. So what sort of fixed cost? When you have taken debt, Lamai, when you have taken a NIR from a third party debt, the interest is kind of a fixed cost, right? That is financial leverage. That means the sensitivity of firms fixed cost of financing. So that is kind of fixed cost. So how much, if your company is more on leverage, more on debt, we call that firm is financial leverage. So the financial risk is there because you have kind of fixed cost. So what is the earning of the equity holders or the shareholders? That is the dividend. But that is the dividend is not mandatory. Every year you don't have to pay dividend. But it's not like the interest cost. If you have taken a debt from a third party, from a bank loan, even from a third party person, definitely at every year, every month, you have to pay it. Every month or every year you need to pay because the interest cost is fixed. So that fixed cost we are going to talk about under the financial leverage, not the operating cost. Nothing to do with the operating in the financial leverage. We are going to talk about that fixed cost, the fixed component which is embedded in your interest or the debt component, right? That is, so if your company is more on debt, that means your companies more rely on the fixed cost of financing because definitely that interest cost you need to pay anyhow. That is not like the equity. If your company is in equity financing, that means the dividend, the return of the stockholder, shareholder, the equity is not fixed. Even in this year, if you don't have earnings, if you don't have profit, you don't have to pay. But it's not like the debts. If you have taken a bank loan from a third party, even like if you taken a loan from a bank, definitely at every year you need to pay the interest, right? Quarterly or monthly you need to pay that interest. So that is kind of a fixed. So if your company is more on those debt and more on your company is paying the interest cost, that means your company is having a higher financial risk. That means your company is having a higher financial leverage. Higher the financial risk, higher the financial leverage, higher the fixed, higher the, now let's see. Then I hope that the difference is clear to you, Laman. Higher the fixed cost of production, higher the operating leverage, higher the fixed cost in financing, higher the financial risk and higher the financial leverage. Did you get my point? if if I am talking about the fixed cost of production, that is, it's involved the operating risk and the operating leverage. Higher the operating risk or higher the operating leverage when the firm's fixed cost of production is high. But if I'm talking about the fixed cost of financing, that means you are much on the debt. So that means you have a higher financial risk. So that means you have a higher financial leverage, right? Knowing the difference between these two, if will be enough. Do not think about these equation and all. So I'm not going to talk about this latter part, right? I hope that would be enough for you, right? So what you need to do is, Lamai, when it comes to beta, this beta determine, the first thing is business risk, and the second one is financial risk. So when it comes to the business risk, it's all about your company operations and your company business operating activities and business activity. So the first thing is cyclicity of revenue. If a company is much rely on the business cycle like automotive and retailers, that means your company is much rely on the business cycle. That means you have a higher risk. So that means cyclicity of revenue is much high. Your revenues much depend on the business cycle. So that means the beta is high. But operating leverage means if your company is much rely on the operating fixed cost, that means your company's business risk is high. So the operating leverage is high. And when it comes to the financial risk, under the financial risk, I'm going to talk about the fixed cost of financing. So your fixed cost of financing, or you have taken more debts, and if you have to pay more interest cost, that means your business financial risk is high. Therefore, the financial leverage is also high. Okay, so these 2 points determine the beta, and I hope that you know how to calculate the degree of operating leverage and degree of financial leverage as well, and also the degree of total leverage. Right, that is what you need to know at this level. Right. And then when it comes to, I know I told you that even many times, multiple times, even in the beginning of this lesson, I told you that, right? When it comes to financing, the company has two options, whether to go for debts and whether to go for equity, right? Issuing shares or issuing debts. So when you're dealing with equity, when you're dealing with shares, right? The cost that we call it as from the firm's perspective, cost of equity, right? But from the investor's perspective, that is the expected rate of return. But since we are talking about the all about this cost of equity and all about this issuing shares and all about the debts from the company's perspective, therefore we need to go with the word cost of equity. So if your company is if your company is financing your capital, or if your company is financing your fixed investment using the issuing shares or using equity, we call that cost of equity. The cost that you need to incur is cost of equity. But and even at the same time, let's say your company is going with debts as well. So that means you need to pay your debt holders the interest and all. So we call it as cost of debt. And altogether, I told you that we can call it as cost of capital, cost of equity plus cost of debt, right? But you need to make sure that each of the project cost of capital would be different from the entire firm's cost of capital. We cannot say that if one particular project, now let's say you are about to start a new project in your company. Let's say there are 10 projects in your company, right? So each of the project could have separate cost of capital, separate cost of equity. Because now let's say you are planning, let's say you are a company and you are planning to buy a new machine. The machine is around 20 million, let's say. So that is a one project. And another project you are involving, that means you are going to invest in a large factory or a garment, large factory. So that is would around 10 million. So that is another project. And also you have another project which you are going to, buy 10 vehicles, 10 backhoes. You are into construction and you are going to buy 10 backhoes. So that is also another project. So each of these projects, now let's say first I told you what is the first project, that you are going to buy a huge machine which around 20 million. So how you are going to invest in that particular project is that, let's say you are going to issue some stocks, and also you are going for bank loan as well. So when you calculate the cost of equity and cost of debt, there is a separate cost of capital for that. Now let's take the second one. That means you are going to invest in a factory, and for that you are just thinking of going only with loans, bank loans, not going to issue shares. So there is a cost of equity and cost of capital involving separate for that project. And let's say in the third project, let's say you are going to, I told you that you are going to buy 10 backhoes, 10 vehicles. So let's say you are only going to go with cost of equity, or only you are going to issue shares. So a separate cost of equity or separate cost of capital is involving in that project. So we can't say that we cannot, combine all of these projects and say that there is only one cost of capital for the firm. No, each of these project is financed differently. For the first project, both the cost, both the equity and debt is there. But for the second project, only the equity is there. But for the third project, only the debt is there. So three different financing structures. Therefore, we need to go ahead with three different cost of capitals. We cannot say we can combine all things together and we can say this firm has only one cost of capital. We cannot say. This is just a concept that I want to tell you. Right? If you have 10 projects, finance differently, right? You need to go ahead with 10 cost of capital, right? So now we are going to see how to find the cost of debt and how to find the cost of capital, because we already calculate the cost of equity, right? Hope you can remember using the capital asset pricing model. We have calculated the cost of equity. Can you remember this? This one, this is cost of equity. This is, we have identified the cost of equity. We have 100%. I told you this here. 100. The firm is 100% equity finance. If the firm is 100% equity finance, we have only the cost of equity. So we have, using this capital asset pricing model, we have find out how to find the cost of equity, or the cost of capital is this amount plus here 30%. Even the cost of equity, even we can say the cost of capital, because only thing is we have only cost of equity, no cost of debt involved. Now we are going to see how to find the cost of debt and the cost of capital as well, right? I hope it's clear to you. Okay, now let's calculate that one. With that, we can finish off our lesson. Okay, right. Right. Then now you know how to calculate the cost of equity, right? I told you that if this is the firm, right, you can finance using two ways, either cost of equity, right, or else you can use cost of debt. Cost of debt, right? So these are the two ways that you can finance, right? Cost of, how this cost of equity is coming when you issue shares, right? How this cost of debt is coming when you go for debt, external debt, right? So we know how to calculate the cost of equity because we have calculated using the capital asset pricing model. We have calculated. Can you remember RF, risk-free rate plus beta into RM minus RF? So this is how we can calculate the capital asset pricing model and or the cost of equity. Now let's see how to calculate the cost of debt. So how to calculate the cost of debt? Cost of debt, cost of debt is equal, how we can calculate? We can calculate is that interest expense, your interest expense. So the interest expense, right, into 1 minus tax rate. This is how you need to calculate the cost of debt. I told you that if you have taken a debt, what should be the cost? Cost should be the your interest. So definitely you need to take the interest rate. But you need to do a small adjustment. That is, you need to adjust for the tax rate, right? So that means because this is because for the that because you are getting the tax advantage, but in your level you don't have to know that. But just remember that since because you are getting the tax advantage, you need to adjust for the tax rate, because if you're only taking the interest rate, that is not correct. You need to adjust for the tax benefit. That means you need to take the interest rate into 1 minus tax rate. This is how you need to calculate. Okay, right. So now let's calculate. Then what is you need to do? You need to add this cost of debt and the cost of equity, and let's see how you need to calculate the cost of debt and cost of equity, and then how you can calculate the cost of capital using the weighted average cost of capital. Okay, right. But having that in your mind, now let's move to the next slide. Okay, right. So first now let's calculate here. I'm not see. So if you are going to calculate the cost of capital, right? If you are going to calculate the cost of capital, the first thing is you need to calculate the cost of equity, right? So don't read this. Listen to me. The first thing, if you are going to calculate the cost of capital, you need to calculate the cost of equity. Then you need to calculate the cost of debt. Then you need to see what are the weightages. That means I told you that even the company can go for equity and even the company can go for debt as well, right? This is the financing methods. So we need to see how much the company is invested in equity and debt. Sometimes the company might invested in equity 80% and on debts 20%. So we need to see the weightages, or sometimes the 50-50. or sometimes 20% of equity and 80% of debt likewise. So you need to see the weightages, you need to calculate the cost of equity, and you need to calculate the cost of equity, and finally you need to calculate the cost of capital. I'll tell you how to calculate the cost of equity. So when you are in the process of calculating the cost of capital, well, what is the cost of capital? Cost of capital means both the cost of equity and cost of debt. So for that, first you need to calculate the cost of equity, then you need to calculate the cost of capital, then you need to see what are the weightages, and then you need to calculate the cost of capital, right? First you need to calculate the cost of equity, then you need to calculate the cost of debt. Sorry if I may make you confused. First thing is, now we are in the process of calculating the cost of capital. Haridam. So when you are in the process of calculating the cost of capital, first thing is you need to calculate the cost of equity. Then you need to calculate the cost of debt. Then you need to see the weightages. And then finally you need to calculate the cost of capital. Okay. So now let's do a small question and see. The industry average beta is 0.82. The risk-free rate is 3% and the market risk premium is 8.4. Can't you calculate the cost of equity using all this information? See here, the beta is given, but the industry beta is given, not that company's particular beta. That doesn't mind, right? We don't mind that because the beta is there. And the risk-free rate is given here, and also the market risk premium is given here. So how you can calculate the cost of equity? You can use the capital asset pricing model, right? That means RF plus beta into RM minus RF, right? So what is your risk-free rate? Here the risk-free rate is given, that is 3%. So 3% minus what is the beta? Beta is 0.82 and the market risk premium is already given. Not the market return, the market risk premium is given. That means this one is already given, that is 8.4. 0.82 into 8.4%. So can't you now solve this? Yes, you can solve this one. How you can solve it? 3% plus 0.82 into 8.4. So that means you are getting 6.88 around. Or let's say 89, let's say. So 6.89 plus 3, you are getting 9.89. 9.89. See, the answer is already given in here as well. Right? So you can't say that you don't know how to calculate the cost of equity, because in this slide, earlier slide, we have calculated the cost of equity. Why I have told you that in the initial of this slide to calculate the cost of equity, because I just wanted to come to the beta here. So otherwise you don't know what is beta now. So I want to take this lesson to beta as well. So therefore that is why I told you how to calculate the cost of equity in the initial phase of this lesson, right? So you know how to calculate the cost of equity using the capital asset pricing model. Okay, so we are done with that one. Now let's see. The yield of the company's debt is 8%. See, for the companies, now the company has taken debts as well. For that debts, we need to pay the interest, that is 8%. And the firm is in the 37 marginal tax rate. So the tax rate is around 37. I told you that we cannot take this 8% directly as the cost of debt. We need to adjust for the tax rate as well. So how can we calculate that one? Cost of debt equal interest rate is 8%, interest rate into the 1 minus tax rate. So interest rate is 8%, 8% into 1 minus tax rate is 37%. So that means we can write it as 0.37, right? So 8% into 1 minus 0.37 means 1 minus 0.37 means 0.63, right? So that means 8 into 0.63, that means 5.04. So this is my cost of debt, right? This is my cost of debt. So this is my cost of debt, that which is 5.04, and my cost of equity is 9.89. But in order to find the cost of capital, we cannot directly uh, at these two values. We need to see what is the ratio. That means what is the percentage of equity and what is the percentage of debt. So in the question itself, it's given debt to value ratio is 32. That means how much of debt they have taken and how much of equity that they have taken. from the total percentage, debt is 32. So they have taken 32% of debt from the 100% of cost of capital. I mean 100%, 32 is debt. And how much the equity? 100 minus 32, that is 68. So the 68 is equity. So this is equity, this is debt. See, debt is 32. So from the 100%, now the firm is financed 32% from debt and 68% from equity. How did you take this 68? 100 minus 68, sorry, 32. Then you are getting 68. So if you want to cross check, please add 68 and 32, then you need to get the 100%. Right? So now what you need to do? You need to do is that, right? So now your equity is 68% and your cost of equity is 9.89%. And when it comes to cost of debt, you have taken 32% of debt, but your cost of debt is around how much? I can't remember, 5.04, right? 5.04%. So what you need to do is in order to calculate the cost of capital, or we call it as weighted average cost of capital, you need to take the 60, let's say 68 is 0.68. When you divide it by 100, 0.68 multiplied by 9.89, which is your cost of equity, plus 0.32, that is 32%, into 5.04. So what is your cost of capital? 0.68 into 9.89, that is 6.73 approximately, plus 5.04 into 0.32, that is 1.61. So that means altogether 6.73 plus 1.61, you are getting 8.34. 8.34. See, we are getting the answer. Did you get my point, Lamai? So this is nothing new. I'll explain it to you again, right? So what we need to do is, I told you that any company is financed by using equity and debt. So when it comes to debt, that is cost of equity, the cost that the company needs to incur. And when it comes to debt, the cost that the company needs to incur is cost of debt, right? So cost of equity, how can we calculate? Using the capital asset pricing model, right? So we know how to calculate it, RF plus beta into RM minus RF. But when it comes to cost of debt means simply the cost that the company needs to incur is in the interest cost, interest. So we need to take the interest, that is I. But you can't directly take this interest cost as 8% or 5%. You need to adjust for the tax rate. That means 1 minus tax rate, right? So that is what we need to do. And but then when you calculate the cost of capital, you can't directly take the answer which comes from the cost of debt and the cost of equity. What you need to do is you need to adjust for the weightages. That means how much the company is invested in equity and how much the company is invested in debt. Now let's say the company has taken 50-50. So that means you need to multiply this. Now let's say forget about all these, this one. Now let's say the debt they have taken is 50%. Now, right? So that means your 0.5. How did I take the 0.5? That means මේ 50 බෙදනවා 100. ඒක තමයි දශම 0.5 වෙන්නේ. So the 0.5 into 9.89, that is my cost of equity, plus again 0.5 into 5.04. 5.04 means this is my cost of debt. So simply you need to multiply these two and add. So that is what we are going to do. That is cost of capital. Hope it's clear. So you need to very much concern on how much the weightage of cost of weightage of debt and equity. So after you have identified the cost of equity and cost of debt, you need to multiply it and be very careful. You need to multiply this debt weightage only from the cost of debt. You can't multiply this by cost of equity. Now let's, the word equity is given here and the equity value is, let's say, 80%. So you have to multiply this 80% from the cost of equity, not the cost of debt. Cost equity weightages should be multiplied by the cost of equity. Debt weightage should only multiplied by the cost of debt. Don't, maru karanna ba. That is it, right? So then you are getting the cost of capital. So that is what you need to know, right? The cost of, you need to first calculate the cost of equity, then you need to calculate the cost of debt, then you need to see what are the weightages. If the debt weightages is 20%, you need to multiply that debt 20% from the cost of debt. Then cost of debt, debt percentage 20% means your equity percentage is 80%. So the 80% should be multiplied by the what? Multiplied by the cost of equity. So that is all you need to do. Then you are getting the answer of what? Cost of capital, right? So that is it. Okay. So that's all about. So just read the slides again and do the calculations as well. So that's all about this. Okay. So we are done with the cost of capital. Okay. So thank you very much for listening.